Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. Today we are lucky to have with us Steve Penny, a SilverChartist on Twitter. That's kind of where I follow a lot of his work. And I wanted to reach out to him, get him on here, get his opinions on the market, and maybe start with your background, Steve. Kind of a little bit about your background and what you're seeing in the markets coming up.
Well, yeah, first of all, thanks for inviting me on. You're someone I keep hearing about a lot, and I followed a lot of your posts, and I've been meaning to really dig in deeper to a lot of your research. It seems like we have a lot in common. We kind of look for those contrarian views and look how to play, reversion to the mean. But look forward to a good conversation. Yeah, my background, I was in the Air Force as a pilot for 18 years, separated a couple of years ago to pursue something I'm really passionate about, which is the markets and financial education. I don't have any background on Wall Street or anything like that, and I think that's a good thing. I like to say self-education is the highest return on investment. So I'm a self-learner, and really got into technical analysis back in 2015. But my eyes were open to how the global financial system works and debt-based fiat money and the Federal Reserve and all of that, central banking, back in just before the 2007, 2008 great financial crisis. And once you kind of learn about how that works, it becomes a rabbit hole that once you see it, you can't unsee it. And you're like, why don't they teach you this in school? So I've been on that path for 15 plus years now, and I'm continually learning and love being sharpened by people like you and others in the space.
So when you're looking at the markets, I know you take a very technical based approach to it. Do you look at any of the fundamentals or anything like that, or do you look at kind of the maybe the market balances of whatever you're investing in? What do you kind of look at, and what's your approach to investing, and what are you seeing in the markets right now?
Yeah, I like to say fundamentals tell me what to buy, and technicals tell me when to buy or when to sell. So I like to find these kind of really contrarian plays that are deeply out of favor, and then you can use the charts to kind of pinpoint precision buy points and sell points along the way. I like to put like 90% of my account in kind of a longer term buy and hold and wait for that mean reversion. But then I take a 10% slice and I'll trade the swings. Like right now, things are starting to get a little bit technically overbought in the short term, so I've been taking some profits in that trading account. That's kind of how I see things. I'm a contrarian, but I'm not also open to playing the swings on the way.
Okay, so you use technicals and you look at the technicals for entry points, and
Mm-hmm.
then really when things start to move, you kind of back off a little bit. It's like, hey, we're up 30, 40, 50%. Let's cool off here. Is that kind of how your approach is? I mean, what
Yeah,
what
but
what gives
yes,
you that buy? Do you using ratios, or is it just technical analysis, or a combination of all those things?
fundamentals and technicals in multiple time frames. So, like for example, a handful of months ago, silver was down below $18, and all of these sentiment indicators, technical indicators, were suggesting deeply oversold. The COT report was extreme bullish, and we were due for a really sharp rally. So I was scaling in aggressively down there. Well, now we're up about 40% from those lows. So in my trading account, which I want to stress, that's only 10% of the overall because I think silver is going much higher. But in that trading account, this is where I've been taking profits, and I'll look for that next pullback.
Okay, is there something that you can show us or something like that with kind of how that looks from a strategy standpoint? What does your entry point kind of look like? You're talking silver here, and kind of how do you scale out? Are you scaling out? Are you kind of selling at one point? You take 50% or 20%? Kind of what's the strategy?
Yeah, and so just want to continue to distinguish between the long-term account and the short-term account. The longer-term account, I like ratios. I love ratios. I know you're a big ratio guy too.
Yeah.
So for my silver long-term exit strategy, I look at the Dow gold ratio, silver gold ratio, real estate to gold ratio, those kind of things. But on the short term, just I like to keep things very simple. So if you get technically stretched against resistance, there's a very high likelihood you're going to get a pullback. So general rule of thumb, this is just one indicator. If RSI gets above 70 on the daily chart and you're at a very clear and obvious resistance level, well, that might be a good time as you're approaching that to take profits. I was in Newmont Mining. That one was just taken to the woodshed a few months ago. Over the summer, I think it got down to like in the 40s. And that's where I was scaling in and established my trading position. Well, now it's rallied up really nicely to the 200-day moving average. It's getting technically stretched. RSI is right near 70. So that was a good time for me to kind of take profits in that one, in the trading position, not the long-term account.
And what sectors are, when you say like long term, What sectors do you really, really like? I mean, is there ones that you keep getting drawn back to? Are you just holding in a certain percentage of your portfolio and you're saying this sector, this sector, this sector, and I'm just going to ride it for the entire commodity bull market? What are those sectors, and maybe what kind of portfolio or strategies do you have playing that?
Yeah, I think my overall thesis is that commodities are going to outperform for the next decade plus. I mean, they've just underperformed for so long that we got to this historic extreme and mean reversion. Things don't just revert to the mean, they go to the opposite side. I think that's going to be a 10 to 15 year or maybe even more trend. So within that space, well, what are the best commodities? Well, from my perspective, I like silver, uranium, copper, gold, and platinum. I know oil and natural gas can do really well as well. They're just not I don't have that fundamental expertise in those areas. So I will trade those sectors, OIH, XLE, but I don't have like longer term positions in those. But silver, uranium, gold, platinum, and copper are the handful that I really track closely.
You excluded my favorite sectors.
Yeah, I can
Yeah.
tell just looking over your website. We got a lot in common.
Yeah, yeah. Oil, gas, and your energy services are kind of my favorite bread and butter, and then uranium I like a lot. So when you play these guys, are you favoring the cash flow producers? Are you favoring some of the junior guys? Do you have a mixture of all of it? What does that entail or look like as well?
Yeah, I love that question because I have a well, I go mostly towards the royalty plays. That's my largest positions. And then I like to put small money into the explorers and developers, the highly speculative ones. About 20% of my portfolio is in the explorers and developers. And I love that question because you get a lot of new people, especially when the sectors are hot, like they are right now. And they come in and say, well, what stock should I buy? That's the first question they ask. And they pile all into explorers and developers. That can be a viable strategy as long as you have a plan and you know what you're doing. But the more boring kind of large cap royalty plays, those are the ones I plan to kind of hold through volatility, where the explorers and developers, I'll be quicker to take profits as silver moves up towards 50 and uranium up towards 70, 80 triple digits.
And so for your explorers, and I just want to talk on this because I know when people ask me questions, they're always about exploration companies.
Yeah.
They'll say, what does this chart look like? What does this look like? And they're like 20 million market cap companies that I've never heard of. I'm like, man, you're really rolling the dice here. What, over the years, and you're choosing a lot of these junior mining companies, like the small little guys. What's been your success rate? Not you like personally, but like what's been the success rate for yourself in these junior mining companies? Have you hit like 10 or 20% of them? Because it doesn't work out very well for me.
Yeah.
I don't like it. It's very hard for me to say, yeah, this one looks really good. And then you just get decimated on the back end.
Yeah.
What about you? What's your experience with these junior companies in silver and gold and stuff like that?
Yeah, I haven't tracked, I don't have exact numbers, but roughly I'd say maybe 2 out of 10 do what you really hope they do, if that. I mean, that's actually pretty optimistic. 2 out of 10 explorers, developers actually become a mine. That's pretty good if you're getting 2 out of 10. Maybe 2 or 3 out of 10 kind of completely disappoint. And then maybe, that middle chunk kind of, you don't get decimated, and maybe they move with the sector, but they don't outperform like you would expect. And I think that seems to be kind of across the board. And really, the more I learn about the junior mining space, the less I want to have anything to do with it, to be honest. I sleep better at night with those royalty and streaming plays and the ones with cash flow and that are producers. But there is a place for them in my portfolio.
Now, here's another question, because I always get decimated in the gold and silver sector. It seems like when I go into those small little guys, it's not, what I mean by decimated, it just seems like my success rate is really, really low. And I'm the same way. I kind of veer away from those junior guys in the gold and silver sector. What about the uranium sector? What's your experience with the junior guys in the uranium sector? Has it been a lot better than gold and silver, or has it been worse?
It's been better, and a lot of that is due to market timing. Let's chalk some of that up to luck. I accumulated the vast majority of my mining stock position in uranium in March, April 2020, which you couldn't ask for a better time. It just happened to have cash, and it was perfect timing for me. So they've done really well. But my perspective on that sector specifically is it's such a small market anyway, that I don't really need that much torque with the explorers and developers. I'm more inclined to go with the kind of larger cap names. and have, proven deposits, the denizens of the world.
So yeah, just to reiterate for everybody. So you've got the Lassonde curve. You've got two kind of humps.
Mhm.
The first hump's the exploration hump, where you can get a lot of value that is created for investors. The second one, it seems like you're playing that one more. I am as well, which is the developer hump, where you get all the value created off the second one. And I think that's a good way to play it, because you're not rolling the dice necessarily. You're playing a leveraged play to the price of uranium. So, kudos to you for that. That's the way I'm doing it too.
And one more thought on that. I think everyone needs to know their strengths and weaknesses. So, my kind of strength, where I maybe have an edge in the market, my edge is using the charts and technicals. So the more liquid names respect those technicals much better than a super thinly traded, micro cap stock.
And when you look at some of these companies or some of these opportunities, how are you evaluating the risk reward in these? I mean, what's your approach there? I mean, it seems like you're kind of similar to me. Like, I don't like the junior stuff. It's too risky. The rewards may not be worth the risk that you take on, but is there any type of approach that you look for risk reward or anything similar to those ends over there?
Well, I don't think I have a formula to share, but yeah, it's really hard to articulate. I think it's a case by case basis. Like, the royalty and streaming companies, for example, they're well diversified. They've got jurisdictional diversification. They've got cash flow. So it's really hard to see them going to zero. Most of them anyway, the decent ones, where you can just see if the metals move in our favor. They've got that leverage as well. So like, I just see a really favorable risk reward setup there. Downside risk is minimal relative to that upside potential. Where the explorers developers, I mean, they can literally go to zero. It happens all the time. So you need exponentially more upside potential to make up for that risk.
And I'm sure you're using technical analysis to also manage your entry point, the risk, because you're buying things that are probably smashed down quite low. Do you have any examples that you can show us, maybe, or things that you use to evaluate, maybe from a chart perspective? It could be ratios, it could be anything, or anything that you're following in the markets right now, where you're like, wow, this looks good, or wow, this looks really bad in the commodity sectors, or wherever you're following.
Sure. Yeah. Go a lot of different directions with that. And one that really has got my attention, and this is a long-term chart. So this isn't like, hey, rush out and buy this tomorrow kind of thing. This chart goes back a long time. I'm going to share a platinum to gold ratio chart. And as I'm sure your listeners are familiar with, because I know you're, you talk about platinum a lot as well, but it's rare for platinum to trade less than the price of gold. Well, normally it's at a premium to the price of gold. Well, it got to like less than half the price of gold. The ratio actually got down to like 0.3 something, which is a historic anomaly that is, I don't know if it's ever been seen, if not, at least in the last 100 years.
Yeah, I don't think it's ever been that cheap outside of the one anomaly time.
Yeah.
Yep.
So here's a chart I'm looking at. Platinum to gold. This goes back to 2000. So just over 20 years. And you can see this very clear downtrend line in this ratio. And here's that extreme historic anomaly, March 2020. Well, we had this downtrend line. We broke out in 2021, came back and back tested it, kind of consolidated along this line in 2022. And then you've got this newly formed resistance line that's, 2 years now. Well, we've broken clearly above that resistance line. So if platinum returns to this ratio up near 2 to 1, that would mean platinum outperforms gold by a factor of 4. The highs of this ratio go back to like over 2.5 to 1. So platinum could outperform gold by 5 or even more in the years ahead. And it's, the upside potential here for platinum is tremendous. And, another one where downside risk is minimal. It's almost like you get the same upside potential that you might get with a mid-tier mining stock, but without all the risks. Is, metals don't go bankrupt, companies do. So platinum really looks appealing here. Not necessarily right now, because it's run up pretty far, pretty fast. We're due for a short-term pullback, but I think the trend has changed, and this metal really has my attention.
Yeah, I'm a huge platinum bull. You had me at platinum.
Yeah.
What?
So if you don't mind me asking, flipping the script, I mean, so how do you play platinum? Do you have like some of the miners, or do you more in the metal ETFs or anything?
I am very heavily weighted the metals, the physical metals, like very heavy, like 99.99% in the metals versus any of the mining companies. And you hit it. I think you did it pretty well there, what you said, because you said the risk reward And the metals I view as the least risky investment of any investment you can ever make in anything. They're less risk than bonds. So when I look at platinum and I look at silver and I look at gold, I view those as the least risk investments of anything in the investment world. And when you get a ratio that's an anomaly like that, and it's not just gold to platinum, it's platinum to silver, platinum to gold, platinum to palladium, platinum to anything that you want to measure it against, that's your opportunity. It's cheap against everything.
Yeah, so true. This is almost treason in the silver community, but I'm going to show a platinum silver chart here, if that's all right with you, to say something's more undervalued than silver.
I own silver. Don't get me wrong. Yeah. I get it. I like it. Just it's
and
not.
I personally I own a lot more silver than I do platinum.
I do too.
But platinum does have that potential to outperform. Here's platinum to silver ratio. Here's that similar downtrend line that we saw in gold that goes back. This one's 15 years, but regardless, a long-term downtrend line. Platinum has already broken out versus gold, but it has not yet broken out versus silver. So you can make a case it's even further to run versus silver. Platinum could potentially outperform silver. I view it as a little bit more risky, but it's hard to imagine platinum not doing exceptionally well.
Yeah, the last time we had an alignment like this, there's a couple of alignments like this in history. In 2016, rhodium had this alignment where it was cheap against every single metal in 2016. It was $650 an ounce. It ran to a peak of like $28,500 or $29,000, somewhere around there. Another alignment, palladium had this same alignment in 2009. And it went from upper 100s, low 200s, all the way up to almost $3,000. So that took some time. It wasn't overnight. So it took from 2009 all the way to about 2020 for that big run to occur. And that usually links up, palladium usually links up with the overall disinflationary cycle that I've noticed. So that's our oddball that you want to be invested in for the disinflation. And then the inflationary period, it's platinum, silver, and those types of metals.
Yeah, that's interesting.
Yep.
And these really thinly traded markets, like the platinum price could double and no one would even notice. It's not like it's going to be on CNBC or anything.
Well, yeah, another thing that I thought was kind of cool with platinum is no one really owns it. So when people own silver, what do you think is going to happen if silver goes to $50 or $100? They're all going to start dumping their silver, right? Well, what if platinum goes way up, and who's going to be dumping platinum? A few guys like us,
right?
We're just sitting on it. So nobody owns it. Nobody owns it.
Yeah, that's such a good point. That's a great point. And I do think you can look at all these catalysts for platinum, but the investment demand, I think, is the kind of sleeper that isn't really factored into. You look at like World Platinum Investment Council, the potential investment demand gets very little attention. I mean, it's such a thinly traded market, just a small percentage of the precious metals community says, hey, I want some platinum. That can have a material effect on the supply demand fundamentals.
Here's a question for you. See if this is testing the history, if you looked into the background of platinum. In the Weimar Germany hyperinflation, what was the ratio of platinum to gold?
Oh, you got me. I was hoping you would ask me a softball. I don't know.
It was 5.5. So platinum was 5.5 times the price of gold, and gold outperformed silver in that hyperinflation. So platinum was the best performing metal during that hyperinflation back in the day.
Wow. So right now we're just above 0.5. So that would mean platinum would outperform gold by a factor of 11. If we saw that again, if that were to happen.
With very little risk. It's crazy to think that. And I'll show you after this the chart of what it looks like on that ratio. It's going to blow your mind. So what other things do you look at when you specifically, I should say, technical analysis wise? What are you looking at for entry points? Are you looking at like 50, 200-day moving average? Are you looking at the candlestick patterns? Are you just looking at patterns? Is it pattern formations? Is it trend lines being broken? What specifically do you look at as a technical analyst to get your entry points? I'm kind of talking or asking the question from my perspective as well, just to see what I do versus kind of what you do in the approach.
Sure. Yeah. I'm one of these guys who just nerded out on technical analysis. I read all the textbooks, and I would sit, when I first got into this, I would sit here and play with charts for hours and hours. I thought it was fun. I'd be doing it at work and people would laugh like, what's this guy doing? So I started using all these indicators, and there's so many powerful indicators out there. But what I found is less is better. Simplicity outperforms complexity. So I've gradually removed all these indicators, and it might sound overly simplistic, but it's worked better for me. So when I look at a chart, all I have on there on a daily chart is the 50-day moving average, the 200-day, volume on the bottom, and RSI on the top. That's it. I got rid of MACD too. I like MACD. So the first thing I'm looking for is, are we above or below the 200-day moving average? If you're above a rising 200-day, it's the simplest definition of an uptrend, below a declining downtrend. So I know, am I getting into a contrarian thing, if it's in a downtrend, or am I buying a trending stock? Super simple there. And then everyone uses obvious horizontal support and resistance levels. Like, no matter what kind of chartist you are, you're going to look at those. So are there any obvious horizontal support and resistance levels? Are we approaching them? And then what's the RSI? So like I said, if you're overbought, approaching key resistance, very likely to pull back. So that's where I'll start. And then I look for any patterns that are obvious. And I want to stress obvious, because if you see it and it cuts through all kinds of bars and wicks and everything, it's probably not so obvious. I like triangle patterns. I like, the reverse head and shoulders, just because everyone sees those. Double bottoms, things like that. I don't really use Elliott wave, although I don't discount it. It seems too subjective to me. You can ask 2 different or 10 different Elliott wave analysts, and you often get 10 different answers. But that's kind of my overall approach in a nutshell. Combine that with like COT data, sentiment, things like that.
So when you're looking at a potential investment or something like that, or a sector, when is it time to load up? When is it time to kind of be like, I don't trust this area, or I don't trust what it looks like? Like, what I'm trying to ask is, like, what do you look for in an opportunity where you're literally losing sleep at night? You're like, man, this looks so good. I'm so excited for it. What does that setup look like to you? Because I know you've got a technical analysis, you've got the website and all that stuff. I do too. Mm-hmm. And there's certain setups that I see, I'm just like, oh my God, it's ready to go. Is it an alignment? Is it what?
Yeah. I got to credit David Brady with this. He's one of our contributors on the website. He calls it FIPIST. That's his analytical framework. And we see things very similar. So he looks at fundamentals, intermarket analysis, positioning of the banks, Elliott wave, sentiment, technicals, and then /M for manipulation. That's a nice summary of kind of what I look at too. Like an example would be silver, or when it was 1740 a few months ago. COT, the banks were net long. That is so rare. It's only happened, you can count on one hand how many times that's happened. The banks are net long futures market in silver. RSI is oversold in every single time frame. Sentiment is in the dumps. You go on Twitter, everyone hates it. I'm selling all my mining stocks. I mean, the more things you get like that from a long-term perspective, that's where I just can't buy enough. Conversely, when you get everything overbought and it's the opposite, it's time for a pullback. Like silver and gold are looking really good here. So is uranium. It's looking like it wants to go. But like looking at the chart for gold in all 4 time frames, it's getting pretty stretched here. That doesn't mean it can't go a little bit higher, but we're up against resistance 1920. That was the high in 2011. So we're right at that resistance level. RSI is overbought. Everyone's euphoric. You see rocket ship emojis all over Twitter. That's probably a good time in the trading account, maybe take some off the table and wait for that inevitable pullback. So there's always going to be pullbacks. I'm not touching the long-term account. I sell on that based on ratios, but the short-term trading account, things get overbought.
So you talked about gold here. Is there a way that you could yank up a gold chart and kind of maybe talk us through? You said it was overbought. Mm-hmm. What you might be seeing, because I know the retail sector, they almost solely they trade based off emotion. Mm-hmm. So when they see things go up, they want to instinctively run into something. What's your opinion on kind of the gold price right now? Because we've had a pretty good run. Mm-hmm. Is this something you want to run into? You want to like pull back on? You want to just say, hey, let's hold on a minute? Kind of what's your opinions there?
Yeah, I think it depends on the individual situation. So for example, mm-hmm. general thoughts, let's say you've got zero exposure to the sector, you've got a lot of cash, and you've got no physical metal. I think everyone should have some exposure to physical silver, mm-hmm. physical gold. I'd say, buy a little bit right here. It's probably going to pull back, and you might say, oh, you're very likely to get better entry points. But you want to at least have a seat at the table. Where if you're like all in and you've got zero cash and like, you're over leveraged, yeah, this would be a good time to take some off the table. But if here's multiple time frames, and I'll pull up each of these charts individually. But this is gold. This is the monthly chart in the top left, weekly chart, lower left, daily, and then hourly candles. So look at the RSI on each of these. That red line is 70, so getting pretty stretched there. Same on the weekly. Daily is extremely technically overbought. The most overbought it's been since March of 2022 at the start of the Ukraine war. Hourly candles are stretched. So we're overbought in multiple time frames. But that said, we've seen higher highs, higher lows. We're back above the 200-day moving average on the daily chart here. The 50 is crossing bullishly above the 200. This has all the markings, everything you would need to see to say, yep, this is a trend reversal. We've got check, 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 check. Institutions notice these things. Trading algorithms notice these things. So I think those kind of institutions, big money investors are going to be in a buy the dip mode as opposed to a sell the rally mode. But that said, we're due for a dip here, in my opinion. It doesn't have to come tomorrow. Could go a little bit higher, but I'm building cash right now, and I've liquidated most of my trading positions.
Okay, and that's mainly based off of the relative strength indicator, would you say, or what are you using as your basis? Is it how far it's stretched above the trend line, or how far it's above the 50-day and 200-day?
Yep, that's one thing you can look.
Yeah.
Yep, that's one thing you can look at. Distance above the 200-day. You can see how far we are above that. The RSI is overbought, and then another thing we can look at is the COT. Here's the platinum COT, by the way, but I'll pull up the gold one really quick. And this just shows the pitch. I like to see what the bankers are doing because they tend to know things before the retail. And COT is like more a neutral structure. The longer these blue bars are, that shows the commercial bankers shorting. So they're shorting into this rally. Could go a little bit further, like I said, but that's just another indication that we're due for a pullback. The smart money is shorting this rally, the notoriously right bankers. And then if you go back on the monthly chart here, not to get too long-winded, but 1920, this is the high in 2011. I'm going to drag this all the way across, and you can see that's right where we are now. So that's another resistance line to watch. It's also the high right here from May of 2021. So resistance right here.
Yeah, I've noticed on some stocks on the relative strength indicator, the RSI, that you can go way up above 70 and ride above 70 for a long time.
Yep.
What makes you think that we're not going to do something like that, or is this just the trading account where it's like, it's okay if I just book profits, and if it keeps going, I've got my long-term account? But what makes you think we're not going to stay up there?
Both. So it is the trading account, and that's what I do in the trading account. When things get frothy, I take profits because it's only 10%. The 90% I'm holding for the long term. I'm not selling for 20-30% profits. Much bigger targets of mine. But also, yeah, you're exactly right. Sometimes things get way overbought, and they just stay that way. S&P 500 for the last 10 years. I mean, it just stayed overbought. However, that's more the exception than the rule. That's not often the case. More often than not, the vast majority of the time, when you get technically stretched in all time frames, you're due for a pullback. It doesn't always happen. Nothing's 100%, or else we'd all be rich. But it's probabilities, not predictions. Probabilities we're due for a pullback.
What are some things that you think most retail investors that you work with or that you converse with or whatever, what do you think some of the things they usually get wrong are, and things they should kind of watch out for? Because, it's been years for me to learn and to kind of develop to the investor that I am today. That took many, many, many hours of trial and error, looking at charts, looking at different ratios, seeing how things interact with each other, and then kind of taking mental notes of that throughout all the years. What do you think a lot of retail investors struggle with, and what are some things that you try to help these retail investors get through?
Yes.
Like your experience.
Yeah. Oh man, I love that question. So number one, I'd say position sizing. It's easy to learn a thesis and become so convinced of it, like I am with silver and platinum and uranium. I mean, I literally can't see a scenario where those don't play out, but that doesn't guarantee it. So I put my position sizing is such that if I'm wrong somehow, like I'll still be able to feed my family. I'll still be able to retire at some point in my life. I mean, it would suck if I'm wrong. I've got a lot, heavily allocated, but I'm not 100% in where I'm living on the streets. People do that. I did that when I was early on, when I learned about silver and gold. I mean, I was just all in at the worst possible time. So that's one, position sizing. Number two, scaling. Use pull. If your strategy is to buy and pullbacks to support, do that. Have a plan, have an accumulation plan, and have an exit strategy. I like to say, whenever you push the buy button, have a subsequent plan to push the sell button. Just have a plan. It can be written in pencil and you can change it. But if you look at the commodities bull market, specifically silver in the 70s and into 1981, so many people were correct on the thesis, but I don't know the exact number, but so many of them never pushed the sell button, and they rode silver back down, and it took decades to get back to where it was. So have a plan to push that sell button, and my exit strategy is to sell into strength, scaling out slowly. I'm not trying to nail the exact top.
Do you have any general rules of thumb maybe for a retail investor? So for instance, I'll just make one up here. If you take an average, and like a 50-day average, or if you take some sort of 20-day moving average, some moving average, when you get extended above it, don't buy. If you get below it, start to load up. Is there any sort of kind of general rules of thumb that you use, either for yourself or people who follow you?
Yes, there's someone who's had a big impact on my trading, and that's William J. O'Neill. He's the founder of Investors Business Daily. He wrote the book, How to Make Money in Stocks. Very different investment outlook than me. He's more into general equities and things. But he's got a rule of thumb where if something gets, I want to say 60% above its 200-day moving average, that's a sell signal. It's not the only one, but it's a potential sell signal. That's something I always keep tucked away in the back of my mind. But that said, you got to take into account the sector you're in, the type of stock you're in. Like a small cap uranium miner could be 200% above its 200-day moving average, and that's not really abnormal. So that's just a general rule I keep in the back of my mind.
Yeah. Uranium's a little bit more ridiculous with the movements. So I'm trying to think of some other really good questions to dive deep down into. What other stuff that you want to just share in general? Do you have anything off the top of your head? Or any questions for me?
Yeah, I do have
kind
a
of going
question
back.
too. As you're thinking of questions, I've got questions for you too. Maybe I can have you on our channel. That'll be cool, and come talk to the members.
Yep.
But I was scrolling through your Twitter feed before this, and I saw you talk about general equities and solar stocks too. I like to trade those. So that told me like, hey, you're not like, so when you mention like general equities to sometimes as commodity bulls, it's like, that's treason. What do you mean general equities? So it seems like maybe you trade those. What's your outlook on things outside of hard assets and general equities? How do you play those?
Yeah, so I have zero, like I'm not pro anything or anti anything. I am pro everything.
Yeah.
I spent a lot of time trying to figure out this name right here, finding value finance. Notice there's no commodity, there's no gold, there's no silver. I will be drawn to whatever has value. And whatever has a good chart pattern also gets me intrigued. I love technical analysis. I think it allows you to look at the markets and gather data without any narratives or any garbage with it. So what I can do is I can paint my own picture based off of the data and the patterns that the herd is creating. And that is really where all the value is in the markets, because you're taking the raw data, looking at it, and then you're only as good as what you've learned yourself. You're not limited by anyone else's thoughts. You're not limited by someone's opinion or bias or whatever it is. So I like stacking many charts together of the entire, we'll call it the entire market, and then saying, why is this happening? And what you're going to see is you're going to see all these different charts stack up, and they create a picture. They create a reason why they're trading at certain levels, why the ratios are blowing out to either the upside or the downside. And then you can look deeper and you're like, okay, interest rates are causing this. Then why are interest rates moving? What causes this? And you just kind of go down and drill down to what I think is a root cause or the root reason why something's moving. So when I look at solar and I just look at the chart, I'm going, man, this looks really good. These look like they could go higher. It's also a function of, I think, liquidity easing in the markets. Like you can kind of tie this together. It's not just, it looks good because the technical chart pattern.
Right.
It's saying, all right, if solar's going up, maybe interest rates are going to go back down. If Ethereum and Bitcoin are going to go up, well, maybe there's more liquidity. And you kind of, I just look at all that stuff and start creating the narrative, I should say, the narrative for it or the reasons why. And that's what I use it for. So I look at everything. You'll be better if you look at everything than be looking at one sector or two sectors.
Yeah. Yeah. You articulated my exact thoughts too. I wish I might record that and steal that from that whole.
Well, yeah, you can just, and yeah, it'd be fine going on your channel and your website or whatever and doing whatever. But it's taken me a long time to figure this stuff out. It didn't take 2 years or 3 years. It's taken like a decade plus to kind of figure out some of these things and see how they all tie together. The platinum to gold ratio that we were looking at, I mean, that is signaling a market condition change. That means something. There's been people from, I think it was Yale did a study where on the platinum to gold ratio, where if platinum outperforms gold, you're in an environment where stocks underperform and it's an inflationary environment. So not a lot of people look at that stuff, but I kind of nerd out in that sense and try to find the reasoning why behind these ratios and what the differences are when they change.
Yeah, totally random statistic, but this data is from 2017, so it's even more extreme now. But as of February 2017, if you look at like percentage of months that platinum to gold ratio was below a certain level, there was only 4% of the months since 1971 that it was below 0.85, and now we're down at 0.55. And that was in 2017, so now it's probably closer to 3-something%. So like it just goes to show what a historic anomaly this is. And I love the way you said that. I like to say price and volume precede the news. Like the charts, I used to just read newsletters and I'd read hundreds of, maybe not hundreds, but I'd read 100 pages a day, something like that, market commentary. And that was great. But that same hour or so spent looking at charts is so much more valuable to me. It paints a picture. It's unbiased. It's not people's opinions. This is actually what's happening in the market. And then you can paint a picture of what's actually happening. And then, then the narrative tends to follow because price and volume precede the news. You asked for an example. Another one that comes to mind is the 10-year, the yield on the 10-year treasury. And this switching gears a little bit, but this comes to mind. We broke above a 40-year resistance line on interest rates on the 10-year. This is one of those exceptions where we got to a resistance line where the most overbought we've been in decades, and we kept moving. So we're kind of extreme overbought here. I kind of think yields are going to pull back, but this looks like a major trend reversal in yields. Like the 40-year bond bubble, to me, has burst, and it ended with this blow off top in March where the yield got to like 0.36%. That said, nothing goes in a straight line. You can see how fast we've moved here. This is unprecedented on the yield, and that's going to affect everything. That 10-year treasury yield affects everything. So we're entering a new paradigm that's going to be around for years to come, if not more.
Do you see any bottoming patterns there in that yield?
Come back to the chart.
When it bottomed out?
Right here. You could.
Looks like an inverted head and shoulders, doesn't it?
It does, yeah. And also you can look for a positive and negative divergence. So like down here at the lows, you can see we made a much lower low, but RSI made a higher low. Conversely here, look at the RSI. It's trending lower. We're making lower highs in RSI, but the yield is moving higher. So that shows, momentum to the upside is slowing. Doesn't mean the trend is reversing. I think we're going to be in a trend, a multi-year trend of higher interest rates, but we're due for a big pullback in the yield on the 10-year.
I'm going to ask a complicated question. Do you know the reasons, or what are your reasons of why for the 10-year yield increasing like it has?
Well, I guess why it increased from March up until the recent peak, or why it's been decreasing lately?
No. Why you think we could be doing a paradigm shift where we go into an increasing interest rate environment? I know you can see it technically, that we've broken the downtrend, but what are your reasons on why? And I know some people don't get comfortable saying that because they
Oh yeah.
solely, do it off
Oh
technicals.
no,
But
I'm
what
totally
are your
comfortable with it.
reasons?
Yeah,
Okay.
I'm totally comfortable. Yeah, we're running one U.S. centric here, but it's similar all around the world, especially in the Western world. We're running $1 trillion+ deficits every single year, and those deficits are only going to get bigger and bigger and bigger. They're on autopilot unless they're going to cut Medicare, Social Security, military spending, which are these sacred cows that they're not going to touch. So because they're not going to touch them, the need to finance our debt is going to just increase. There's a 4-letter word for why this debt problem is not going to be resolved, and that's math, M-A-T-H. So who's going to finance our deficits, especially at artificially low rates? China, we see they're stepping back. You can look at the tick data, that's the treasury data. I look at that. Saudi Arabia is stepping back. All these major nations that were buyers are now sellers. I think some of that is because of geopolitical reasons and shifting alliances, but also it's because they need their own reserves back home. They don't have the money to reinvest back in. The petrodollar system is, I don't want to say crashing and use these dramatic words, but if you see OPEC, namely Saudi Arabia, start selling its oil in something other than dollars, that reduces demand for dollars globally, and then those dollars tend to get recycled back into the treasury market, suppressing interest rates. So all these things are, what's kept our interest rates artificially low for so long is ending. And, eventually you get to a point where the interest on the debt consumes 100% of the tax dollars. Where that point happens is dependent on the interest rate, but every 1% rise in interest rates with a $30 trillion national debt is $300 billion. And we take in roughly, just over maybe 3 trillion in taxes every year. So the math, it's just bottom line, it's math. There's no avoiding it. They're going to have to debase the currency, and you can only suppress, manipulate something for so long. Eventually manipulations fail, and the interest rate's been manipulated. You Fed prints money to go to the treasury auctions to keep those rates low. Sorry for the long-winded answer, but
Have you been following the gilt market and the Japanese bond market too? Have you seen the problems that are occurring over there? Do you think that's going to have any impact on our bond market at all?
Yes and no. I mean, I follow it. I'm sure there's a lot of people who could speak much more intelligently than me, but there's kind of a general theory in life and nature where kind of the periphery fails first, the weakest links, and then it kind of works its way. So, when you start to see failures in kind of third world emerging markets, and then kind of, the Japans of the world, the Europes, it's eventually coming for, United States, Europe, the more established economies.
Have you also
prelude for what's coming?
Oh, sorry.
No, go ahead.
I was going to ask to the debt. I've looked at some people who have done they kind of dove into the Social Security payments and all that stuff. We're actually running a negative balance on that now.
Mm-hmm.
Now that the baby boomers are coming into those ages where they're going to get paid out. That's one of the things that I was looking at, and I was like, wow, we're going to go into a negative on that with the interest rates going up. And then I was looking at, well, the stock market's gone down quite a bit. That's also another area that generates taxes that they collect on, is positive gains in the stock market.
Mm-hmm.
So this is painting a picture where we could be running some pretty big deficits here over the next few years. Do you think that's going to have a negative outcome, or maybe a positive outcome on our precious metals investments, but negative for the dollar?
Yeah, it's bad for everyone in the world in general, but it's good for precious metals and commodities too. Like I said, these $1 trillion deficits, they're going to have to be financed, and it's always the Federal Reserve that's the buyer of last resort. And most people in our camp have a consensus that they're eventually going to pivot. We can debate when, but they will eventually. And a lot of people point to the stock market when real estate crashes and everything. Yeah, that's true. But another reason is because they have to finance the government. Otherwise they'd be forced to go into austerity, and that's the last thing these politicians want.
And then here's another question, because I think about this quite a bit, and I know I'm kind of just jumping around question wise. It's not in order. If you could go back to your 25-year-old self or 20-year-old self or whatever, right when you started investing, what would you tell yourself? And like, what would you say? Focus on this, don't focus on that. Do this, don't do that. What would you go back and tell yourself?
Well, like I said, when I was younger, I went all in on these sectors, and I paid a tremendous opportunity cost for that as the stock market went up year after year after year, and silver's kind of gone sideways to down, and so have most commodities. So, I wish I took a more balanced approach. That's one thing. I wish I thought more about retirement planning, specifically taxes. Like if you're younger, to me, I'm not a tax advisor, but that Roth 401k, if you're married, make you less than about 200 grand a year, man, stuff that self-directed Roth, because that grows tax free, and you can invest in things like uranium and silver. Man, I wish I could go back in time and stuff that self-directed Roth. So you can only put 6 grand a year now, or right about there, for you and your spouse. 6 for you, 6 for your spouse. But that's one thing I really wish I did different.
Yeah, I think there's a way that you can do it even if you make more than a certain amount too.
Yeah, there is. Yeah, I do that too. They call it backdoor Roth. So you put it into a regular 401k, and then you roll it over, and then you pay the capital gain right then, but then it grows tax free. Yeah.
Yep. So what other things have you learned throughout the years that you'd like to share with the viewers, if you have anything else to share, maybe financial related or strategy related or anything like that, if you have anything else?
I do. I mean, just some general principles. I mean, these are things that are 101, but they're easy to forget. That I made these mistakes myself. Silver and gold, hard assets, investing. I think we're going to make a lot of money here, but limit your position size. Personally, I'm a big proponent of avoiding consumer debt, all consumer debt. Don't take out debt to go buy these things. Do it right. Have some cash savings. Even though it's going to go down, it's kind of your padding for an emergency fund if things go wrong. Kind of a more well-rounded approach is what I wish I did differently.
Yeah. I always avoided debt as well, like yourself. And I see a lot of people when they invest, they take on all the risk. And I always look for the best risk reward, where if your rewards go up and your risk goes up, where does it kind of come where it kind of levels out? You don't want to be out on the ed over here where your delta in your rewards is nothing, but your risk is all the way out in no man's land.
Yeah.
So when I was younger, I took too much risk. I should have taken less risk.
Yeah.
That's one of my things.
Yeah.
Do you have anything else? I don't really have too much else for you, Steve, in terms of questions or anything like that.
No, I don't, man. I really enjoyed this conversation, and look forward to inviting you on sometime soon. And it was great getting to meet you.
Definitely. So thanks for coming on. And if people want to reach out to you, Steve, it's at SilverChartist on Twitter.
It is.
Definitely hit him up and check out his charts. He puts a lot of charts out on Twitter, and that's kind of what I follow, as well as I follow Steve's and some of his opinions. And even if you think that you're a good chartist or whatever, I usually don't really care. I look at everyone's stuff, and sometimes they see something that I'm missing, or they see a sector and I'm like, oh, that sector does look good. Let me dive into it. That's what I really use for a lot of the technical chartists. And I bring a lot of technical chartists onto the channel. And I really, I don't know, get motivated when I look at other sectors that they're looking at that I'm not looking at, that I'm missing. So thanks for what you do, Steve. Really appreciate it. And sharing all those charts on Twitter. It's helping me find sectors as well and kind of clear things up. So thanks for coming on. Appreciate it. And we'll catch everyone next time. Thank you.